Thumbs up. I appreciate it. Okay. Yeah, we're gonna have a stage in the Discord as well tonight to talk a little bit about RTM, some key changes / additions to the room. It occurs to me that people really do want some of this intraday commentary. It helps just to go through the visualization of trades and setups and price action. And I forget sometimes that this is not intuitive to everybody. So hopefully that will be beneficial. And also we'll be adding a special addition to that room as well, which should help with guys who are more accustomed to futures trading rather than options. But that said, if you're in the Discord, that's tonight at 8. It'll be in the free room. We'll talk a little bit about this RTM trading room and the synthesis or the synergy we see between a couple of different modalities of looking at the market. Obviously, my main focus is options, but there are certainly other valuable ways to look at it. And I think we've come up with a pretty good trio of approaches that when there's confluence, it's really, really good. That said, today, this message, or this spaces rather, I try to do a live, like a screen share / on-camera walkthrough of some of the price action of this week, but was not able to actually get a live feed set up. Don't know why that is. Maybe that's only available on the phone. You guys have experience with this, DM me and let me know if I'm off on this, but it seems like the PC version, you can't do a live. That said, I'll probably just I'll post some screens. If you're following me, you'll see them come through. The point being really is to talk about some of the stuff that happened in intra-week. Big week this week. Obviously, there's a lot of talk about the ridiculous amount of notional that was expiring. I hope for most of you guys here that it's pretty obvious by now that notional does not always translate to real risk, right? That was obviously, it's fodder for headlines and everything, but it doesn't actually mean anything when it comes to risk. This is true also managing positions internally. Like we used to deal with a lot of clearing constraints that had to do with notional valuations that never really mapped to our actual risk. My biggest frustration was always when you'd had to reduce risk, like quote unquote, air quotes risk. But in reality, what you had to do for the clearing firm, increase your risk, though it reduced your notional. Just a lot of silly stuff that happens out there. That said, some of the week's price action was not really as confusing as all the hysteria made it out to be. Obviously, you guys know my perspective. This seems like we're maybe in a little bit of a spot up, vol up type of area in the market for a number of reasons. First and foremost, whenever you go through these big structures, when I say big structures, think like the large call walls, right? So the JP Morgan collar that lives below now at 65.05 is pretty well in the money, it's deep enough in the money to begin to lose influence. Like every day that passes, yes, there's a charm that's going to compel some kind of passive selling. Right now, there's still a bit of vol. So as far as Vega goes, there's still some ability for that straddle to go up, which actually has the net effect of hedging flows that are market makers buying futures rather than selling. But the point is that generally speaking, we're not pinning that strike at this point. There's going to be some weight on the index, but we're by no means like in this range where a pin at 65.05 is necessarily likely, for lack of a better term. I'm going to post a couple of screenshots to the feed overall. So you'll see them if you're following me. I don't know if there's another way to do it. Let's see, there's a chat. Okay, here we go. I'll post them in reply to the main post. Just to go over some of the stuff that happened this week. So big inventory rolls off, but a lot of that inventory has nothing to do with real risk. It's deep in the money, it's rolls, it's boxes, those all kinds of stuff that don't have any real risk for the market. There were some big positions. For example, going into AM OPEX, there was a pretty big dealer short at 66.5. Hopefully, if you guys look at the, or if you recall, the price action going into Friday morning, for example, we had some key reversals off that level in the overnight. And then going into the morning, we clearly pushed off that strike to the upside and kind of like, nailed this like high print through the negative gamma. If you guys are in the Discord, I hope you listen to the call on Friday intraday. OPEX weeks are interesting. A lot of times on OPEX, we have an early fade, and I have some hypotheses as to why that is, but Friday was very clean price action. I think the replay of the call I did on Friday talking about the XYLD flow is very, very worth listening to. It's very trappy, that idea of gaming that flow in general, but I think I explained the price action well, and it was supposed to be an educational call, but what wound up happening was the market actually kind of did exactly what I suggested it might do. So very good look into the plumbing and the other side, and a reminder that like you have to kind of treat this stuff as there are levels to this, for example. And so just knowing that somebody's selling doesn't mean that we have to sell. That's oftentimes not what's most likely to happen, which is obviously not the case on Friday. In fact, if you were just kind of in the space and following along, and you knew from the first level of commentary that there's a selling program in the market, that this buy right fund, Global X ETF that sells naked calls or live at the money calls in the SPX, the first thing you would think is that we're going to sell off in this window. And in fact, it was almost perfect, like start to finish. The period that they were selling delta, selling live calls, we actually rallied pretty steadily through the entire window. But that was very predictable in some sense. So I'm going to start posting some stuff to the replies here. So just I want to note here, the stuff that we're going to talk about, this view that I'm sharing here is interesting in the sense that it's kind of evergreen. And so I'm going to post, this is a slide from Goldman's recent note. This is a strike distribution of SPX options expiring in September. And what I want you to take note of most specifically is just where the distribution of those options is. So at any given expiration, you're going to have a profile that kind of looks like this. I can't wait to have a screen share up next time. Okay, but for the lack of ability to do so, I will mark it up a little bit. So you have some large inventory at 5,000. You have some large inventory at 6,000. You have large inventory. Well, no, actually you don't. You have some small little perking up of inventory at both 4,000 and 7,000. And then, of course, you have a cluster around spot levels. Real options and vol trading, in my opinion. But you also have this kind of like sweeping, looks like a mountain, right? If you're looking at this thing. So I'm going to post it again, reply to myself here so you can see what I'm doing with the annotations. Again, if you're following the chat, like on the bottom right here, there is a little chat on that shows a couple of replies. I'm posting to that icon, meaning if you open that, it shows this feed. With the annotations, what you can see is there's these clusters of inventory. There's also this buildup, this like range that looks like a mountain range that peaks around at the money. Just remember, every quarterly expiration, you're always going to get this kind of stuff, right? Quarterlies especially. And again, I posted a little bit of a thread earlier explaining this. It's combos. Whenever we trade live stuff, whenever we trade things, this is not live technically, that are like negotiated trades on the floor or upstairs that are then brought to the floor and crossed, things that are not necessarily just sent through the electronic complex order book or screens right away. They're usually tied up. When I say tied up, that just means that they're paired with a combo. The combo is a call versus a put on some ratio against the underlying trade. And that ratio is the delta of the trade to make it delta neutral. So if I buy a 30 delta call 100 times, I'm going to get with that a sale of 30 combos, a sale of 30 calls and a buy of 30 puts at the same strike to hedge the delta away. This makes it a locked trade for negotiation. It makes the whole process smoother. But what it also means for our purposes and for like the data pundit purposes is you get a lot more inventory, right? Especially when the market has a big range. So we rally up range where September is what we call the driver month. Everything that's traded this way is tied that way. And we get this buildup of inventory that never really nets out, right? If this were always done at the same strike, like let's say the industry just said, hey, we're going to use 6,400 all the time. All the calls and puts will be netted out on this strike. You would get a lot of balance in the end. Instead, what you get is every single strike in the range by 5 points in September. For the purposes of hedging all these trades, packaging all these trades with their hedges, you get just a buildup that never goes away. And so because it's never closed, it's just additive as you move through the range. Every strike has more inventory on it, when usually you're not used to seeing every expiration have a buildup across every 5 strike levels, every 5 points in strike level. It doesn't go away. So it creates a notional creep, right? And so when you look at the distribution of where notional gets big, it's always quarterly expirations. That's one reason quarterly is always going to be bigger than any other expiration. The other basic thing that you have to keep in mind is this is, in principle, always going to go up when the underlying goes up. So to the extent that we're rallying, you should expect that given the same amount of order flow with the same distribution of interest at different strike levels relative to spot, notional goes up. And I say this, and I was kind of like beating a dead horse for some of you guys, but just remember, when you read all this hysteria about a big amount of notional coming off the curve or coming off the, snapping off the chain, it doesn't usually mean anything. As you can clearly see now, this was the largest SEP OPEX in history, according to everybody and their mother who watches options, but we didn't move, right? We had a 50 basis point rally Friday, which was mostly done pre-market. I forget what the actual close was, like 66, 64 or something with a 71 top. But if you recall, when the SEP future expired, we were trading 66.58, I want to say. So just keep that in mind. There's nothing formative and predictive here with respect to this particular inventory. That said, as far as price action goes, it was actually a pretty interesting week for trading. So we're in this kind of range where there's a bit of a spot up, vol up potential. We had, however, spot down, vol up still. Fixed strike is still maybe moving higher a little bit. You can see skew coming off, meaning like the relative valuation of puts versus calls. Puts are becoming a little bit cheaper relative to calls because fixed strike vol is going up a little bit on the rally. But we didn't really have any major shock from the FOMC. They did kind of what was expected. There's maybe some dispersion in the dot plots, all that kind of stuff, but this big macro risk is now behind us. Was it tradable? Yes and no. You guys know my perspective. I think it's prudent to be hedged in this range, obviously at all-time highs with a lot of uncertainty ahead. And just practically speaking, looking at the combination of monetary policy and interaction with the administration, there is real risk right now that I think makes sense to be prudent at the highs. As far as the actual price action day to day, this I think is highly tradable whether or not you have a long-term view, right? So you don't need to be hedged or bearish. You don't need to be necessarily all in bullish, but I think every single day offered a little bit in terms of how to trade it. It's very, very tactical, short-term, whatever you want to call it. There's always opportunities. Now, the purpose of this, I kind of want to bring it back to this day-to-day view and remind you guys that there's opportunities all the time in between this stuff. And the lens that I use is, of course, related to my history. It's the dealer profile, right? And so just to be very clear, when I talk about gamma and charm and these influences on the profile, they're mostly dominated by zero-day options. That's just the case, right? There are other influences that are a little more complex and maybe lend themselves to more nuanced analysis, but also more variance in how they express themselves, like Vanna and Volga, for example. Don't think those are easy ones to trade off of. I think if you nail gamma and charm as far as how the market interacts with gamma and how charm defines levels and trends, you get a really clean set of influences to trade. Some of these requests to speak, this is kind of flying blind. I'm going to approve some of them and just trust you're going to ask good questions and not be completely ridiculous. We'll see. But I'm going to start with first, just give me a second. I'm going to start with, what is this? 9, 15. I'm going to go back before the FOMC, right? I'm going to post a bit of a recap into the feed, so you can see for yourself the price action that I'm talking. Just get a second to pull that up. To the guy who requests to speak, if you have a question, go ahead and ask now while I find the chart. Otherwise, don't worry about it. Okay, so this is going to be 9/16. This is the day before FOMC. Now, what do I kind of mention all the time with respect to FOMC is that we have, in particular, a kind of like a deer in the headlights moment. And I say that not lightly. It's like if you're in the industry, you kind of know that there's a lot of waiting and seeing, meaning like nobody's really making big decisions ahead of the FOMC. It's a known unknown. Everybody agrees on the fact this risk is ahead of us. Most people just wait and see how it resolves. And so that offers good opportunity sometimes to, in the way I look at it, is if I know that there's something that has to happen today, meaning the zero-day option chain has to decay, to know that on balance, for my expectations, historically doing this professionally, nobody wants to trade too much ahead of this big event. Gives you a nice setup, right? Where you can kind of lean into this charm influence a little bit more than you otherwise would. And so I'm going to show you the price action that unfolded on this date. I'll post it in the chat here or in the replies. We'll look at how clean, like we had a bit of a waterfall down early, right? And that's an early move. Sometimes you get that associated with Vanna. This was a day in which the straddle was kind of artificially suppressed. If you guys look at the straddle prices on the 0-day before the Fed and after the Fed, clearly like you could see the difference, right? We're talking $17, $18, $19 before the Fed. And then all of a sudden, even Friday, even though we didn't have much of a move on Friday during the day, the straddle, I think, came into the day around $30 or $29. So just very different set of expectations before and after. But before, the straddle kind of outperformed. So the chart I posted here shows the market kind of selling off from 66.30, et cetera, that area, all the way down, really touching, I think the low was literally 6,600 on the dot. Maybe, the chart says 6,600 spot 11. Right. So was this necessarily predictable? Yes and no. Right. So when you have this understanding that there is a reason for no one to act, charm is actually a little more playable, and the charm profile on that date heavily suppressive. The reason I point this one out is specifically that morning on the 16th, it was clear the profile itself was shaping up to reinforce the mechanics that produce this. So this is an intraday profile. This is still from options depth, obviously. You can see the way the position that you see on the page, I call this a dealer long risk reversal. It means instead of buying underlying equities, the customers are actually buying calls. So you have inventory on the left-hand side, and then you have inventory on the right-hand side, which reflects long. So shorts above, longs below. This is obviously in the middle of the day after some of the move had already happened. But I want you to look at what happens here as price moves higher. It finds resistance around 66.15 and then never quite breaks through. This is the same kind of thing that we saw again the following day. Obviously the eventual move after the FOMC was higher, right? Risk resolved higher from 6600 area, certainly to 66.5. So we kind of stepped up 1% in terms of where the landings were. But before the event, this idea of suppressive charm came into play a couple of times around 6600. And so whenever you see positions like this, just know that what's happening, you can kind of intuitively understand if someone buys calls from me as a market maker, shot clock on these calls. If I sell the upside calls, I buy futures, these calls will decay, but my futures are static. They're not decaying with me. And so as the day wears on, this idea of charm just says that if I'm short upside calls or upside options, I have a delta hedge in the D1 instrument, the futures of the stock. I'm going to have to kind of sell out on a cadence, on a rhythm as we approach expiration. It's not really up for grabs whether it happens or not. It has to happen, and it produces a passive flow. So like the trades happen, there's this one-off kind of punchy influence that gets, maybe it makes for a little bit of an erratic move in the market. But then to the extent that we don't gap through and follow through on the move, we remain below the cluster of upside calls that we as market makers have sold to customers. We start to see the influence of the delta being sold drive us back down to where our own position absorbs the market. Right. So in this case, you see 6600 wound up being a very clean place to find the bottom. But on the way back down, we tested 6615, didn't go through it. The way I look at this, a chart like this, as far as the inventory goes, I want to see the market get through 6620 to change the nature of what I just described. Right. So if you get these calls where on balance, a lot of them are in the money, then all of a sudden, instead of decaying out the hedge, where these calls go 30 or whatever delta to zero, and I have to sell the futures that I bought against them out, the opposite happens, right? If they're in the money, they actually wind up doing the opposite thing, which is they go from 70 delta to 100 delta. And instead of selling out my hedge, I'm actually not hedged enough. So I have to buy more of these futures, which would have the opposite effect, right? This would actually push me, if you're looking at the same profile, my most recent post here, this would actually push me towards like 66.30, 66.35 maybe. No real huge influence from the upside inventory past 66.20 because these are small options. Nevertheless, I want you guys to understand where the influence comes from and why this is so valuable, because the lens we use for this is not a maybe type of lens. It's like literally there are hedging processes installed in the market that work on a super fast cadence, and they're very rigid because the volumes are tremendous, right? Back in the old days when things had more variability, more time to expiration, there was more discretion with how we manage the positions. I think it's safe to say that we're not going back to those days. A lot of what's going on in the market right now is very rigid and high frequency, which makes actually for a very efficient market in terms of one side of the coin as far as efficiency goes. I think, though, that it also makes for a set of predictable outcomes. Some would describe as inefficient, but I think they're just two sides of the same coin. Like for the business practice of market making, this is a very efficient system. But obviously, most people think that any market that has any type of predictability in it is inefficient. I would just disagree. That shape that we just saw there on the profile, where it looks like calls above, puts below, it doesn't always drive you to the biggest position. That's not the point. You have to take into account the context of what the deltas that are remaining are. We used to run things called zero vol to evaluate where positions ran out of influence, et cetera. Really valuable approaches to kind of assessing a viable target. But oftentimes, you just wind up gravitating towards the middle of the dealer's long cluster and away, you get pushed away like two magnets of the same pole from the dealer's short cluster. So that was 9/16, and that was before the Fed meeting. Now I'm going to show you guys what happened on the day of the Fed meeting too. The point home first. So this is not a knock on options depth at all. This is a facet of how people look at this outside of the market that is difficult to wrap your head around. But this is a charm profile right now on FOMC day. If you look at the timestamp when I pulled this, it looks like maybe 1:30. So not right before, but within maybe 30 minutes of when the actual quote unquote number comes out, right? And so what I want to make clear here is that day, and really the positions in September in general, have this element of suppressive charm, but accelerant upside to them. Two sides of the same coin, where we can decay the options out and we'll just have a little bit of a sell-off and a pullback. Or if there's real buying, it can get a little bit erratic and spiky. That said, when you look at the charm profile, and I'm going to use options depth as an example, when we release our platform, it will actually look kind of similar in nature to this because there's only so many ways you can reinvent these wheels. I think spot gamma looks a little bit similar, but I like the gradient, the depth of the coloration here. It's more obvious to me, this suppressive orange charm. So on this profile, what I'm trying to highlight is this was Fed day. What you need to remember, if you're ever trading these influences, and this is what I'll tell the mentorship all the time, what I tell the VS Pro guys all the time, this is not a normal decay day. Meaning, on any given day, if you look at the way the 0-day straddle behaves versus the way it'll behave on a Fed day, it's very different, right? There's an event at 2 p.m. It's the only event that people care about. Like literally for the purposes of the model, time kind of stands still. Meaning if you're expecting all of the suppressive charm to be quote unquote realized, it's not going to happen, right? Like actually throughout this entire process, if you're waiting for any kind of decay flow, meaning like passive selling because market makers are long so many puts, short calls to drive the market lower, you're kind of waiting in vain. It wasn't really going to happen because if anything was ever going to happen, it would happen at the event passing. It's almost like all of that decay gets pent up. The straddle vol just gaps up, right? Because what you're doing is you're taking a metric that says evaluate the straddle price given X time to expiration. And a naive model will not vary time at all. It's not waiting time. It's not evaluating whether this like the next hour. It's just saying time is passing. Before it had 8 hours expiration, now it has 3, etc. The vol is just in our eyes on the outside going up. But from the market maker's perspective, what's happening is their model's just basically accounting for this by flatlining theta until the event. Hopefully that makes some sense. By the end of this process, it all comes out kind of at once. And then when you look at the price action on the 17th, it was not only erratic, but so we had this move up. Share this really quickly. A tremendous move back down, very volatile overall. I think it's safe to say, like, and I always try to remind people that when you have a lot of flows colliding in the market, you have to kind of downshift or throttle down the expectations of the efficacy of the way you look at it, because it's just basically of, your slice of the pie is smaller because the bigger pie, it's just, you have a small slice of a bigger pie. And so look at the price action here. Although I do want to bring it back to this point about upside call speculation versus real delta trading. I'm not sure if I have the inventory at my disposal at the moment with respect to Wednesday's flow, but shoot, you know what? I should pull this. It's pretty valuable to have. Let me see. Should be in our RTM room, I assume. What I want to point out is that what happened on Wednesday post-Fed, there was again a tremendous amount of call buying, and the strikes, if I recall, the cluster of strikes that were most prevalent were 66.30. There was like this cascading wall of calls, like crescendo of call buying ahead, but that never you never saw any real buy-in with D1. It was all call buying in 0 day. And so there's this spike that you can see in the chart that happens in the price chart, for example, when the number comes out, then obviously we fade away. And so most people read this as like, oh, the market has a headline algo reaction where we spike up and then we wait for Powell to speak and they don't like what he's saying. But the reality is there's a lot more going on under the surface in the models too, right? So for one, this is all happening against a less liquid backdrop. Like I'm sure market depth in general across all tradable assets that are hedges for this instrument is just lower. It's always the case. We would even withdraw our quotes or pull our quotes, widen our quotes into these numbers, whatever it might be, just for the sake of not being picked off, right? Nobody wants to have too much market risk during these events. But when these calls failed to print, failed to go in the money, the first thing you should look at next is, well, what should I be expecting after that? And really, it's probably a tendency to fade. And remember, this is going to be an end-of-day snapshot that I'm going to show you. Pretty soon, there will be 1-minute intervals available for this kind of stuff. Right now, we have 10, but not every platform makes it available all the time. The reality was, on this date, more of the speculation intraday was at 66.30. So I'm going to just draw a quick line here at 66.30 on the chart I'm going to share with you. And imagine that the bars that date were actually a little bit more stacked with the peak there. And then there was clear ledge against which the market was kind of implied to land. I'm going to post that right now. This is the end of day position, but it masks the amount of information you have from all the intraday trading, of course. There's, we could have a week-long call about how to read the intraday updates, obviously, but just for our purposes, we'll keep it brief. 6630 was kind of where the bulk of interest was intraday. Got to take my word for it a little bit here. There were stacks of calls that were bought by customers interim also, but it provided this shape again. And you should always take note of when this shape shows up in the inventory, where it's like a cascading effect, a cluster of shorts above us, longs below, and the dynamics work the same way if you flip them. But the idea being that if we don't get through this, if we don't actually pierce through and get to the point where the bulk of options that were bought are in the money and decaying as such, the fact is the next thing that happens in our model is there's enough of a reversal where you actually slide back through the range. And also remember, this range is kind of a negative gamma range. All these 0-day options that only have short time to expiration, they do have some gamma to them. Obviously, the straddle on FOMC day was pretty expensive, so not a ton. But the sliding back through the range and then punching all the way down, we had a lot of flows hit during the press conference, of course. But in the same vein, on the way back up, if you zoom in on this profile here, there was again this idea that like we have to cross critical thresholds in order for the market's base case kind of theta and decay and charm flows to take hold. I almost view it as like passing the baton, right? There's this like collision of real flow that happens. There's gamma hedging along the way. But then if you just turn off all the buyers and sellers because they've done their bidding, the market's going to do something that depends on the options, and depends on just the combination of the option position and also how much vol still has to come out of those options. Wednesday was an interesting one. It looked like a very bearish day, but there's probably just a lot of corrective positioning. And then when we came back up to this range, what I noted at the time was there was a pretty big void in between the inventory. Now, if you guys listen to my calls a lot in the Discord, I mentioned I like trading voids more than dealer short or dealer long. Not always. Dealer long, I think, is the easiest side to trade. But when there's a void in the inventory, I actually like it a bit more than when there's a big customer position. Why is that? Well, if there's no real interest in a line, for example, let's say we have a position like a risk reversal where there's a bunch of dealer shorts below us and dealer longs above us, but they're far away from each other and nothing in the middle. The reason I love this is because if you had, for example, big positions in the middle on either side, kind of imbalanced, imagine like a string of dealer shorts or whatever. First, it muddies up the charm and gamma hedging influence. It's cleaner when it's like one clear structure. But the void is nice because it doesn't leave you with many possibilities in terms of large net decisions to be made from the customer side. For example, what I like about a dealer long position is if you know the way the order flow kind of shakes out, on the institutional side, especially stuff that's already there going into the day, most of the trading is to sell options and most of those options don't get closed. So what that means from my perspective as a market maker, if I'm looking at the dealer position and I'm looking at a bunch of long options on the market maker side that were there going into the day, I kind of treat those as static. Like the set of options that are there in the morning, they're probably still going to be there as the backbone or the structure of the profile at the end of the day too. Because most of these funds or institutions that sell these things, with a few exceptions, don't come back to close them when they sell them. They're not like trading with the same constraints we are. They're more like quant or, think of like a casino, many small bets, properly placed across time. Like that just is the nature of the game. Makes your influence more reliable. That's what I'm trying to say. The same thing is not true when options are bought. In general, when options are bought, first of all, you're not going to see a ton of options bought ahead of the date that will remain on the profile going into the date because real firms do roll options. And then when you do have customer longs, dealer shorts, options that are bought, you wind up having situations where, retail and institutional come in the morning and trade. Retail will usually close their options. So anytime that retail is buying options, you have to kind of keep in mind in the back of your head, there's this possibility that some subset of them wants to close their options, and there can be a race to the exit when a move happens that makes them in the money. And so when there's a void, I guess to bring this back and drive it home, a void in the profile is sometimes nice and neat because you get a range through which you can move because there's not a lot of implication there that customers will be doing much. If you look back on the intraday profile on FOMC day, there was actually a substantial void between most of the profile from the low 6500s to the high 6500s. Just keep that in mind. This came into play, I believe, again, one more time in the week. Give me 1 second here. All right, 1 second. There was another day this came into play. It was actually kind of cleaner in some set. I believe it was just the following day. Sorry, my son's in the room too. Okay, I found the profile I was looking for. I believe it was just the next day. So this is 9/18. Okay, so the commentary I put in the Discord here was kind of, I'll just copy and paste it exactly verbatim. Again, this kind of plays into the idea of a void. So I'm just giving you a couple of like samples on how to think about this stuff. It's different, profiles come up every single day. But the point is, this is often very, very tradable if you understand how to look at it. This is how I remarked about the profile at the time. So this was September 18th, the day after the Fed. Obviously pre-OPEX, a lot of shoring up of positions ahead of this major, the largest notional in the history of the world. And then what actually happened, of course, not much, but let me show you the price action on the 18th. So this is commentary ahead of time. And part of what drove my commentary was the nature of that profile. Not a lot of big positions from which to work with. Let's see here. In this case, we actually had, I think, a little bit of an end of day buy signal that drove us back higher. All of which happened though, like you can almost see, I'm going to post the actual price influence here, because this also demonstrates how to derive counter information from the profile. So there's something very clear about this position I just posted. And you'll see in the price action, we didn't actually get to where you expect to go, right? So this profile, if you're looking at it and you're just thinking about dealer hedging flows, you would expect that there's kind of a negative gamma area and a void. What happens? The market finds some support. Is this a tell about what happened on the next morning? I don't know. But what should be clear, even just constraining the read to that particular day, right? Because it's a 0-day position and then there's an end of day spike. Didn't get us all the way back through. But what I'm trying to point out is that when something is predictable, and I want to be very clear here, nothing is ever predictable 100%, right? But what we have is something that we know will drive in a certain way because that's the way the models work. There's very little ambiguity about the positions on these wider timeframes. There's also very little ambiguity about the actual models that drive the flows. So you put those two together, you have a pretty predictable set of outcomes in a very competitive landscape. We should find evidence of the decay flow pushing us lower. However, what you see here is kind of the opposite. So we sell off from whatever, the 6640s, and the profile itself suggests maybe we could fade all the way down to 6610. But the market does something a little bit different, right? So in this negative gamma range, you should expect things to be more volatile. You also should expect decay to push us lower. When you look at the price action that followed, you can see it found legs over and over and over and then spiked in the end, right? And then what happened on expiration, the next morning, we wound up gapping higher, right? I'm not saying that's necessarily connectable, like purely, but just know that when you see something, I want you guys to think about this properly. When there is a very discernible and predictable outcome embedded in the hedging profile, and you see the opposite of that, or at least I guess I should say more carefully, like it's not necessarily driving as much of the price action as you suspect it would, given its strength or given like the clean shape of the position, your mind should go to the opposite, right? And so options have this kind of duality that's a little bit frustrating sometimes. But if, for example, a profile like this I just showed you shows like negative gamma to the upside, but also a little bit of a void and positive gamma to the downside, the fact is there is a two-sided coin here, right? It says if there's buying, we should go higher. It should be a little bit gappy. If there's selling, it should find support and slow down, almost like a slide, right? Imagine like a slide through the inventory where it's fast in the beginning, but then it flattens off at the dealer's long. In this case, I think it was 6610. When it fails to follow the path, which is kind of like down that slide, it tells you there's someone else here that's playing and they're buying, right? And so they're buying into close, and then you see evidence of that in the last 15 minutes or so. And at that point, with 15 minutes, the straddle is very cheap. But we get moves that exceed the straddle. They're in some ways we're getting good information out of the profile. Nevertheless, it's not always like following the prescription, but in the same realm here, what the profile is telling you is like what could happen if the prescription is violated, right? And so you get this spiky move at the end, where realistically, like a single leg call option with 10 minutes to go, if you're kind of onto this idea that maybe we weren't hedging out the delta as fast as we should, or maybe there's a buyer here that's absorbing the charm flow, it actually paid well. It comes and goes, and obviously that's when you have to look at actual customer patterns too, because one of the precarious things with all the options is when there's a cluster of dealer shorts, customer longs that's added intraday, There's the hedging influence, but then there's also the race to the exits from the customer side too. Makes this very interesting, very dynamic. Obviously, you can't just set and forget things, but there's always information coming from the profile. So I just want to drive that home here. Any questions on this stuff before I wrap up? Because it's 45 minutes already. It's getting a little bit late. We're going to do a bit of a, what is this? I would call it a demo, I guess, in the Discord after this. If you guys want to join, we're going to talk about this stuff. Also, some other ways to look at this as well. So like you guys probably know Farm. You probably have heard me talk about RTM. So RTM is institutional signals. This is options. This is not the same thing, but it's maybe a little bit adjacent. Farm is obviously pretty accomplished in his own right with the way he trades futures. There's actually a good synthesis here that we're going to start kind of plugging into the RTM room. A nice addition, I think, where the intraday commentary, leveling it up a little bit with the discourse and kind of going through this on a regular basis, because I forget sometimes that I've seen these profiles play out a million times. The base case and also the what if is very obvious to me, but it's the repetition that made it obvious for me over the course of my career, and is really what we're going to try to do more of in the room as well, to make sure that those of you who are trying to learn this, trying to wrap your head around it, get the best of worlds. Let's see here really quick. So this will be held, it's a free call, of course, whatever. This will be held in the Discord in the stage. This will give us a chance to take questions as well and share screens where I haven't quite figured out how to do that well on Spaces, but we'll get there, of course. Looking for questions, and all I can find are bot replies. This is so maddening. Cool. I'm going to hop here and get set up in the Discord. Just know the stage will start in like 13 minutes or so. I put the link in the chat. I'll retweet it, obviously. But the point is, if you want to come see a bit of a demo of what's next, the additions we're going to make, and also how it all kind of synthesizes neatly together sometimes with some examples from the week, feel free to hop over. Otherwise, I'll see you guys next week.